So Brooke and I want to bring in now Kathryn Rooney Vera. She's Baltic Head of Research and Strategy. So Kathryn, welcome. Great to have you here.
David.
Happy New Year.
To you too.
So let's start out. It's last day of the year. Basically, what are you looking forward to in 2020, given what's happened in 2019? Because it was a pretty good year, basically for everybody.
Sure, it was a great year. And in December, to the day almost, we had a top to bottom correction of near 20%. So since then, we've rallied, what, 25% in the S&P 500. Even emerging markets assets have done pretty well. So recession risk has been priced out. Trade war fears have been priced out. And that's what caused that 20% correction 1 year ago. So going into 2020, what we're telling our clients is that it's very important to protect your unrealized returns. You have some really juicy returns up to this point. So either you liquidate some of them, a portion of it, or you protect the remaining. So one of the active recommendations that I'm telling our institutional clients at the moment is to buy put options. You can buy them through November expiry. That gets you through multiple Fed meetings. That gets you through Super Tuesday. It gets you through the Democratic primary, the nomination, and it gets you through the presidential election. So there's likely to be some volatility. I know, and I get a lot of pushback regarding the fact that in the year up to a presidential election, markets tend to do very well. But we've already done very, very well. We've already done very, very well. And a lot of the outside risks have been completely discounted, have been discarded, let's say.
When you talk about removing that uncertainty, so a couple of headlines from Bloomberg Opinion this morning, Gary Schilling writing about how it's harder to forecast the economy given that we were not really seeing typical cyclical patterns. My colleague Brian Chapata writing about what the market got wrong with the bond boom. How do you predict the market in this environment? How do you have confidence in what we're actually going to see in 2020?
Yeah, you're right, Brooke, and there's a divergence, right? You have the market and you have the economy. So the economy continues to do pretty well. I mean, I was one of the very few who was saying there won't be a recession in 2019 nor 2020 when that was increasingly consensus 1 year ago. And what we thought at that point was that the market was mispricing recession. Now, I have to go the opposite direction because the fact is the market is not pricing in really any negative news. Right? The market is pricing in a complete resolution on the trade front, no U.S. recession, no undesired consequences from the monetary expansionary exercise that we've seen on a global scale. 25% of government bonds are negative yielding. You have a massive appetite for risk because of what the central banks have been doing. So I think there's some inherent risks that the market has completely ignored.
So you mentioned several possible negative consequences. How do you rank those, or do you rank those? What's the thing that is most on your radar screen? I
know people are more talking about this increasingly, David, but my biggest concern is on the political front, right? The market is at record highs, so that's either discounting a Trump re-election because whether or not you like him, he's been good for the markets. You know, we're up 50% over his tenure.
That's undeniable.
Yeah,
I mean,
undeniable.
Whatever you think about President Trump,
right.
He has been good for the markets. No question about it.
The market likes less regulation. The market likes lower taxes, tax code simplification, and less onerous government on private sector's back. So you see, while you have private enterprise and consumer confidence very high, you're not going to get a U.S. recession unless you have some negative shock. So my biggest concern, David, at this point is that you get, the market finally discounting political risk, which is Trump doesn't get elected, or you get a socialist in the presidency. And there's various grades of socialism on the left, but I think that a Warren or Sanders, increasingly looks more like Sanders, if they capitalize on Trump's unpopularity, regardless of where the economy is and the markets are right now, then I do think the markets will drop 25%.
There is a reason why candidates like Sanders and Warren are popular, and we've talked a lot about the divergence in the economy and sort of a tale of two separate environments. Is there a risk that we're overstating the strength of the consumer? Is this consumer really as strong when you look at the spike in installment loans and online lending?
That's a great question. I think it ties into my second risk, which I think is even bigger in a scale and magnitude, but that is not as near-term a risk. I'm talking about Warren, Sanders, even Biden. I mean, anybody who's not Trump has been great for the markets. Anybody who's not him is a very near-term risk. We're going to get that in the next few months. The bigger term risk is the inflation of the consumer appetite, the inflation of risk assets, and that you can tie wholly to central bank intervention. This may not be popular, but the fact is that negative interest rate policy is and can be, and I think will be, detrimental, has caused a lot of manipulation in the markets, and has forced people out the risk curve. I'm an advisor to institutional clients. They are thirsting and hungry for duration. Everyone has gone out the duration and risk curve. So there are people that should not be in risk assets who are, simply for the yield.
So there may be some people borrowing money that shouldn't be borrowing money on terms that they shouldn't be borrowing on. That almost always happens when you have a lot of money floating around. But do you see it in leverage? Do you see it in household leverage? Do you see it in corporate leverage, that we're getting up to levels that are concerning?
Yeah, you actually do. And in the publication that I recently got out there, you see corporate leverage carrying, non-financial corporations, David, carrying slightly more debt today than they just before the Great Recession.
Is that right?
That's not such a good comparison.
No, that's not so
as
good.
a percentage of GDP. So to answer you directly, yes, you are seeing that come into the play.
And I mean, when do you start to see the consequences of that set in? I mean, is that a near-term risk for you, or is that something that maybe we see in a post-election type of environment?
Yeah, Brooke, that's the right question. The question is, what will be the spark to cause this unwinding of risk? And that's not a near-term phenomena, and that's attached solely to inflation. So once you get inflation picking up the pace, and you get central banks, the ECB is now at what, negative 0.5 on the deposit rates. That's a tax on European banks. So once you get inflation picking up and you get central banks sounding less and less dovish, and in fact having to increase rates or come off the negative bound, then you're going to get an unwinding of risk, and I think that's where the chickens come home to roost.
I don't think I heard you mention a risk of inflation. Do you see any risk of inflation returning?
Inflation is and always will be a monetary phenomenon, and I think one of the misconceptions that we have right now baked into asset prices is that inflation is dead and buried and it's never going to come back. Yeah. So will I say over the next year that inflation is a risk? No, my models show that it is not. But it will be. You know, if you get demand pull inflation, you know, that's a more positive phenomena. But I do think that inflation will come back to the fore, especially if the U.S. continues to grow at a nice clip. Europe comes back, and I think Europe will come back on the economic horizon in 2020 and do pretty well. And the emerging markets keep pace.
Kathryn Rooney Vera of Bulltech will be staying with us. We're going to have more on her sector calls. That's coming up next. We've talked about where the markets overall may head in 2020 and where the risks may lie. Now we want to delve into the specific sectors and what we might expect in the new year. Still with us is Kathryn Rooney Vera of Bulltech. So give us your overall sense of sectors. Who should be up, who not so much?
Yeah, look, I think if you look at the sectors, our top picks are going to be real estate, staples, financials. Those are the top three that we see outperforming this year. In terms of valuations, they're looking less rich than other sectors, and I do think that if you have the more bullish scenario, to which I attach a 60% probability, which is current trends continue, then you're going to see the market price in sectors that have heretofore underperformed the stars. So I'm not overweight on tech. It's done so spectacularly well. It's really brought the market to where it is now in the last leg of this year. So I think that we need to be market neutral there. But with regard to where we see interest rates staying and the U.S. economy evolving in 2020, I would have to go with my top pick being financials.
And I noticed that you have industrials underweight, and that is, of course, very
Brooke would ask about industrials.
near and dear to my heart, covering manufacturing. But I wondered if you could just expand on that a little bit. I did look it up before I came in. Industrials, the S&P 500 industrial had its best year since 2013. Is it just that all the good news is priced in, or do you worry about the growth trajectory from
here? And not
here?
to toot my own horn, but that was my top pick for 2019. And the reason that it was my top pick is because of the tax reform. And I saw that really giving a boost to industrials. And in fact, it did. So, you know, we could say, let's continue, let's recommend that you guys still buy that rally. But we think that we've seen the bulk of the rally up to this point, and we actually have recommended that our investors take gains on industrials, which was our top pick for this year. The one country or sector that I have been actively recommending that we've done our top performer this year was in Chinese consumer discretionary. It's up 42%. We've done very well there. And there I do think there is further upside. So in that name, even though it's done so well, and there are ETFs attached to consumer discretionary in the Chinese space, I think there's more room to rally. But in industrials, I just think we're tapped out.
Is that true even in aerospace and defense? Because I know people are a lot more bullish on that boom continuing.
Yeah, when you go into the subsectors, there's certainly going to be different stories that play out, and there I think there would be more value. But in the broader space, when we look at those big ETFs, I do think that we've seen the bulk of the run.
Explain to us about healthcare. I mean, healthcare is such a substantial portion of GDP. A lot of talk about it in Washington, all sorts of different directions. I see it's a little bit overvalued on your analysis, basically, so you're not as enthusiastic about it.
Well, healthcare is a tricky space, especially when you have some Democratic frontrunners talking about, really undoing a lot of the private sector insurance coverage.
Medicare for all, things like that.
Correct.
Right.
So that makes me weary of the space, especially if in February 3rd and February 11th we have Iowa and New Hampshire, which historically, if one candidate takes both, he or she runs the table on Super Tuesday. So I'm very weary of healthcare, and I think the three sectors that would be most affected if you got one of those two candidates as the nominee would, of course, have to be tech, healthcare, and financials.
You talked about consumer discretionary being an opportunity. Can you unpack that a little bit? Obviously, that's a pretty broad category. Are there specific areas within that that you see more potential?
Yeah, I like staples, actually. I think it's going to be a more defensive name. I think we do need to be more defensive this year. There's a lot of euphoria, and there's this herd mentality, right? In December of last year, everyone was calling for recession and protecting yourself. Now it's, if you listen to the talking heads, everyone, it's, the markets are going to go higher forever. Consumers doing very well. I like to take a more contrarian position, and that's why I like going for more defensive, which is consumer staples.
You also have said you're positive on energy. It is undervalued according to your way of measuring it, but sometimes there's a reason why the value is low.
Oh, sure.
Right? I mean, there's some complications with energy.
I couldn't agree more, and actually that was one of the names, David, that we didn't get right this year. But energy, look, I have WTI at 55 per barrel. I have an underweight this year. I think it is overvalued, but as you say, with reason, I don't think it's a place that we want to be buying at the moment.
I mean, just to pivot back to industrials a little bit,
I'd be disappointed if you didn't.
I just, got to get it in. But I was amazed. I mean, for everything that Boeing has been through, that stock has not really seen much of a hit. It's basically where it was at the start of the year. And so I wonder, I mean, as you look out at other opportunities, are there places where you have seen a lot of these risks, like in oil, like in healthcare, where maybe as we get later on in the year, you might see some of that peter out? Yeah, sure. And you're touching on one of the things that we're talking about with our clients, which is pivot points. So if, in early February, we have something pan out on the Democratic front, which moves the markets. Then we pivot. We say, okay, where is the value right now? If the market does fall precipitously and we think it unwarranted, that would be a pivot point. Another one would be on the trade front. Let's say stage one, or there's a conflagration of tensions between Xi and Trump. Then that would be another pivot point. So we certainly are looking for pockets of value, specifically when there's a market dislocation or mispricing.
Kathryn Rooney Vera of Baltic is going to be staying with us, and still with us here in New York is Kathryn Rooney Vera of Baltic. So, Kathryn, you mentioned China earlier, particularly consumer discretionary. You said it was possibly a good investment. But while you were talking, we had someone actually send a message in. It says, what investment vehicle is the best way to do it? Do you directly invest in equities? Is it ETFs? Is it real estate? As you look at China, what's the best way to invest in China?
Well, yeah, there's different ETFs. There's the FXI, which has a disproportionate weighting with the banks. So I prefer ones that are more tied to, more directly to the consumer discretionary sector. You can look at CHIQ or GXC. Those are certain ETFs that have a higher weighting attached to internet company names or big consumer names. So that's the way to play China. And I agree with your previous commentator. It's very interesting to consider this as a phase one, and then what the next rounds will mean for the trade negotiations with China and how much control they're willing to cede to gain that top dog position, which is really what they're looking to be, the superpower both geopolitically and economically of the world. I mean, talking about consumer discretionary specifically, but as you look at the broader China stock market, where do you think we're headed directionally? Well, I think if we in fact do get another phase one, phase two, some thawing of the trade relationship, given the fact that 25% of China's economy is directly attached to exports, then you're more likely than not going to see Chinese equities continue continue to rise. That should bring up the EEM, which is the MSCI Emerging Markets Index ETF, which is now the top 5 are entirely Asian. It used to include a couple Latin American names, but now they've fallen out and it's almost entirely Asian now. So if you want to play ex-Asia, then you have to go into specific names because the EEM is simply not going to give you a significant exposure to emerging market outside of Asia.
You mentioned MSCI. The MSCI is in the process of adding more stocks to the index.
Yes.
What effect, if any, will that have? I mean, Adam Posen expressed, I think, some skepticism there'll be a flood of capital into either debt or equity markets.
Well, it's interesting, David, because emerging markets is now consensus bullish. Everywhere I go on Wall Street with my colleagues in the emerging market space, emerging markets is the next outperformer for 2020. So I concur with him. I think there should be some skepticism, especially with regard to Latin America, which is growing below potential and faces a lot of headwinds, with those that are perhaps unwilling or unable to engage in both structural reforms and fiscal expansion.
If you look at non-China emerging markets, are you still bullish on consumer discretionary in some of those areas?
Well, consumer discretionary is specifically a China call because that's the burgeoning sector in that economy. So that's the economy that the Chinese themselves are trying to harness, right? That's the growth engine going forward. The Chinese authorities, I think it is clear that they realize that, you know, inflated exports and government spending, there's only so many roads to nowhere or ghost towns you can really build. So they realize that the path to sustained economic growth is that of a domestic demand. With regard to Latin America, I would say you need to look at the Brazils of the world. Brazil still has more upside to go, and what the Peterson Institute gentleman, Mr. Posen, said is correct. Brazil has benefited from the trade war. It actually has benefited. It's seen more export destinations, increase of exports of soy, of other materials.
How do you discount the political risk when it comes to President Bolsonaro and Brazil? Because it's not clear exactly where that country's going.
Right. Yeah, well, he still has a few years left. There's no elections coming as of yet. The economy is doing pretty well, and you have structural reforms such as pension reform. So in the political sense, David, I wouldn't look at Brazil. I would look more at Argentina. Will that become a disorderly default? What's going to happen in Argentina? Look at Chile or Peru or Mexico.
Who would have thought Chile? 2 or 3 years ago, who would have thought Chile?
Chile is incredible. It's really a catastrophe what's going on there.
You talked about Brazil benefiting from the trade war. Now that we do have a phase 1 deal that allegedly includes big Chinese purchases of U.S. agriculture, does Brazil then suffer?
That's a very good point. They have accumulated market share, which I think the pie can expand. I mean, if China continues to grow at a nominal pace at the magnitude that we've seen even over the last 5 years, China's been decelerating in real terms, but they continue to add significant amount of aggregate demand to the global economy. There can be that pie growing, and I do think that Brazil has maintained the ability to export and increase their production to match that.
Where are you in Mexico? President López Obrador. Again,
yeah, I think
the private sector's not quite sure where the president is going at this point.
He's scared of them. They're scared. They're absolutely scared.
With some cause.
With some reason. But from a market perspective, Mexican assets are looking remarkably beaten up, and I think that there's a lot of value there. And then on the other front, really, AMLO, while he talks a big game, really hasn't hurt the economy in any significant way. The economy is not in recession. It's growing at a very slow pace, but that's kind of been the story for the past 10 years. So I think that Mexico has some value in it. Actively recommending MA bonos at current levels, and I think there's some value in the fixed income space.
Just to pivot back to China, we had a pretty good PMI reading this morning. Do you think we'll see stimulus from the central bank there, or is that moving off the table?
And that's the other point. Thank you for bringing that up, Brooke, that I like about emerging markets. Those countries that have the bandwidth and the capacity and the ability to really implement fiscal stimuli, which China unequivocally has. So it has the ability to implement monetary and fiscal stimuli without really having to get the approval of any Congress or anything like that. So China has that benefit. They haven't really done it thus far. I think China will see a deceleration this year from about 6% in growth to 5.8. But yeah, I think that's a very good chance.
Okay, before we let you go, I want to pivot back now because we got somebody, it was a viewer who wrote in about something we were talking about earlier. Back to the United States. When you look at the possibility of PE expansion, that's price earnings ratio expansion or contraction, which sectors, if any, do you think are more likely to have expansion or contraction of the price earnings ratio?
Yeah, look, I think that's a good question. If we have the benign scenario, which is the S&P S&P moves even higher and we don't have, any problems. We have the S&P hitting 3,500 by the end of the year, and I would stick with my sectors. I think that if you get some undervalued sectors that continue to see multiples move higher with prices, then you get money flowing into those undervalued sectors and bringing up the prices. So I'll stick with my sectors. I think I like staples, I like financials, and I like real estate.
Do you buy the idea that we should see, sort of a rethinking of what a normal PE ratio is in this low interest rate environment?
Well, a lot of things change when you have manipulated interest rates so low. So I would think that, yes, you do have to reconsider where we are in the multiple space. What is the real level of interest rate? What's the neutral rate? What's the NAIRU? There's a lot of things that we have to consider, and I do with regard to where we are in monetary policy.
Well, you talk about NAIRU and the natural interest rate and things like that. That raises the question actually Brooke just asked, which is, have we seen a structural change in the economy overall?
Yeah, look, the Taylor rule is something that I think we need to consider. And have the inputs changed, or does it no longer work? And I tend to think that the neutral rate is lower. The natural accelerating inflation rate of unemployment is lower, which means that to incite inflation, we need to get even dramatically lower unemployment rate. So it's not that these formulas no longer work, it's that the inputs have changed.
Fascinating. Okay, thank you so much to Kathryn Rooney Vera of Baltic. It was really great to have you with us, Kathryn.
Thank you, David.